So you've filled up your online shopping cart with a bunch of stuff you can't really afford, but you're gonna buy it anyways because you can pay for it in multiple payments. It's a win-win, right? Well, kinda. There are a few things that you need to know about buy now, pay later apps before you get started, because that pay it off later dream can turn into a nightmare real quick if you don't read the fine print. What is buy now, pay later? Well, according to one of the leading buy now, pay later service providers, it's an alternative to credit that gives you the flexibility to buy what you want, when you want, without breaking the bank. Great, so you forego the credit cards that you've kinda maxed out already, and you get what you want anyways. Well, that's about half right. Language like this can be deceiving because buy now, pay later options are in fact credit. The truth is, agreeing to this type of option means you're actually agreeing to a point of sale installment loan, which is basically a short-term loan that allows you to pay back a small amount over a period of time. This means that you'll be signing up for a new line of credit, which also means they'll be checking your credit score. Don't worry, it'll be a soft pull instead of a hard pull, which means it doesn't affect your credit score for them to look, but it does mean you can still be denied. So if your credit score isn't looking too hot, then you might be denied for that TV or whatever it is you're buying. Granted, there are buy now, pay later apps for low credit scores, so you can always look at their minimum and apply if you think you may qualify. But keep in mind, while the pull itself doesn't affect your credit score, if you miss even one payment, that will affect your credit score. One of the major downfalls of buy now, pay later is just the simple nightmare that returning something can be. They won't let you cancel your agreement until the return is processed and you can prove that. And during all that time, you'll still be required to make payments. There are some other downsides to buy now, pay later apps, but we'll cover them in the next video, so make sure to subscribe so that you don't miss out. There used to be only one or two buy now, pay later options out there, but now there are tons. Rather than running through the entire list, go ahead and hit pause on the next screen and we'll go through the pros and cons of all of them. I know you're probably wondering how buy now, pay later companies make money, right? Well, there are a few ways, but most of them bank on small fees or you messing up. Yikes! The first way that these companies make money that doesn't involve you is charging merchants a transaction fee. Similarly to credit cards, the companies just charge the merchant a transaction fee for the amount purchased. It's usually anywhere between 2 and 8%. They make that money. The second way these companies make money is by charging you to pay for their service. Some apps like QuadPay charge a $1 platform fee with every payment. While it doesn't seem like the end of the world, it ultimately means that you're paying more for that purchase than originally advertised. And the last way buy now, pay later companies make money is by counting on you to mess up. Yep, that's right. I know that sounds extreme, but really, if you miss a payment, they'll slap on a $5 or $15 fee for being late, and they'll make a profit. Plus, those fees can increase over time if you continue to miss payments. So make sure to keep track of your payments and don't miss them. Let's talk about accounts receivable factoring. Buy now, pay later companies are factoring companies that businesses sell their accounts receivable to, and then they follow up to collect payment. English please? It's actually pretty simple. The company you're buying from, let's use Target as an example, sells your $100 balance to Afterpay. Afterpay immediately sends Target $98, factoring in a 2% transaction fee, which is how they make money. And then you pay Afterpay that $100 in installment payments. So you might be wondering what types of transactions retailers accept and the fees associated with them. For example, why don't all companies accept buy now, pay later? Well, transaction fees are one reason, but the other might be that they offer their own type of credit, like a store card. Here are some of the transaction types that most companies accept. Cash and debit. Accepting cash and debit is the safest way for a transaction to go through. This is because the retailer is not depending on you to make payments on your credit card, and they don't have steep credit card fees. There are some fees associated, but it's 0.05% plus 22 cents and any fees that your bank might have. Unlike debit cards, credit card fees can increase over time, anywhere from 1.3 to 3.5%. And it varies based on the type of credit card. For example, Amex, Visa, Discover, whatever the case might be. Merchants who accept credit cards also have to pay other types of fees like interchange fees, processing fees, assessment fees, things like that. And lastly, buy now, pay later. This is an option for companies because most of the money comes from you, not from the seller. But they can sell your purchase to them at a discount, usually 2 to 8%. Plus, technically using buy now, pay later increases the cost for you too. Buy now, pay later apps can be great for companies because it increases the number of sales and the potential order value. But the downfall for companies is they'll ultimately make less on the order because they have to sell those purchases at a discount to a buy now, pay later company. That means that over time, companies will probably have to compensate by raising their prices. If you want to know more about buy now, pay later companies, check out the link in the description below to an article on creditanddebt.org. If you liked this video, make sure to hit that subscribe button and stay tuned for part 2 of Buy Now, Pay Later, where we're talking about all the pros and cons that you need to know. Thanks for watching.